everyone. In this lesson, we are going to build on what we've just learned with moving averages and look at MACD, which stands for Moving Average Convergence Divergence. It was developed by a gentleman called Gerald Appel about 50 years ago.
Sounds pretty complicated.
Well, it always does until you've completed the lesson. So, MACD is a lagging indicator that is used to measure both price momentum and trend. This is done to identify potential trend reversals. MACD is also the first oscillating indicator we are going to look at. This means it gives us an output that moves above and below zero.
Well, how's that done then?
There are three parts to a moving average convergence divergence. The first part is the MACD line. This is the difference between the two exponential moving averages of the price of the security. The typical time frames chosen by traders are 12 and 26 periods, so we'll use these in this lesson. Remember that when you have two moving averages together, the slower one moves with more lag, the faster one reacts quicker to price changes.
Yes, I remember that.
Good. So by plotting a line that shows us the difference, the MACD line tells us if there is momentum in the price and the direction. If there is lots of momentum and the price is changing quickly, the shorter period EMA will follow it quickly. The longer period EMA lags behind this. The more momentum, the wider the two EMAs.
Okay, I just about follow.
Good. The second part involves another line called the signal line.
Okay, and what does that do?
The signal line is simply an exponential moving average of the MACD line. It's typically set at 9 periods by traders and it lags the MACD line.
I'm with you so far. So what's the third part?
The third part of the indicator is to subtract the signal line from the MACD line. This value fluctuates above and below zero and it's plotted as a histogram.
Okay, I am a bit lost now. Can you give us an example that shows how this calculation works?
Okay, well, to work out each period takes quite a long time. So what we've done is made a spreadsheet that shows the calculation in action, which is available in your student area. The good news is that these indicators are easy to add to a chart and the calculations are automatic.
Sounds good. I'll be sure to study the spreadsheet.
Next up, let's look at how we apply the MACD to Euro-Sterling currency pairing. So MACD comes under Studies, so let's find it there and select it. So we can see that this adds another area to our chart at the bottom.
So what are these then?
These are the results of the three parts of the indicator we've just looked at, and they line up with the periods in the price chart above.
Yes, I can see that.
Good. So let's check the settings to make sure that we've set the indicator to 12, 26 and 9 periods. These can be found down here.
I'm with you so far.
Okay, so the white line here is the MACD line. The red line is the signal line. You can see it lags the MACD line.
Yes, I'm following.
Finally, the red and green bars in the middle are the differences between the two lines. If we look at the most recent period, the MACD line is above the signal line. So the bars on the histogram are positive.
That makes sense, but what's the significance of the bars being green or red?
Well, if the gap between the two widens, it's green. If it reduces, the bar is red.
Got it.
Next, we are going to look at how MACD reacts to price changes. Let's stay with this chart because we can talk through how the MACD reacts to price changes as they happen.
Sounds good.
Okay, let's take a look at the MACD line. If this is positive, the shorter moving average is above the longer one. This means there is upward momentum. When the positive values increase, it indicates an increase of bullish momentum. And when the positive values decrease, it indicates that the momentum is reducing.
That's pretty easy to follow.
Good. Now look here. The market breaks out to the upside from a consolidation, which is confirmed by a positive MACD.
Yes, I see that.
As the trend builds momentum, the MACD is also increasing. The same is true on the downside. This downward trend is confirmed by a negative MACD.
I'm following.
Now, look here, where the price falls quite dramatically during the two periods. The bars on the histogram get bigger in relation to the others.
So, does that mean the price is gathering downward momentum?
That's right. If we look here, the price is trending up. But because the move is gradual, we get convergence between the MACD line and the signal line. We can see this in the smaller or non-existent bars on the indicator. Remember, the bars are measuring the momentum of a move and not the move itself. Okay, now let's look at how traders use MACD.
Sounds good.
Traders use MACD to alert, confirm, and predict the trend and momentum. They do this by using several techniques. Let's bring back our chart to walk you through it. So, a signal line crossover indicates a possible turning point in the MACD. A bullish crossover occurs when the MACD line crosses up over the signal line. This is interpreted as a change in the strength of a price move. We can see that happening 5 times in our example.
I'm guessing then that a bearish crossover occurs when the MACD line crosses down over the signal line?
Yes, that's right. There are bearish crossovers here. These crossovers are used by traders to suggest a trend reversal. However, a crossover when the MACD is extremely high or low, like these ones, should be treated carefully.
Why should they be treated with caution?
Well, because the MACD also indicates strong momentum in these areas, which can suggest a continuation of the trend rather than a reversal.
Okay, so what's the centerline crossover then?
A center line crossover is another MACD signal. When the MACD crosses up over the central line, it turns positive, indicating that the shorter period EMA has crossed up over the longer period EMA.
Okay, I'm following. So if the MACD line turns positive, what does this actually mean for the market?
This would indicate that the trend has turned bullish.
Got it. And if the MACD line crosses down over the center line, does it indicate the trend has turned bearish?
It certainly does. If you think about it, this is the same as the moving average crossover strategy we introduced in the last lesson, albeit with EMAs instead of SMAs.
Oh yeah, it is, isn't it? Just now via the indicator below.
Because we got a chart of the price and MACD line up, we can start to see insightful patterns emerge. Divergence between the price and momentum is one scenario traders pay attention to.
I'm not sure I follow it.
Okay, the MACD indicates divergence when its highs and lows don't match the highs and lows in the price. Look here, there is a new price high, but that does not correspond to a new high in the MACD. In fact, MACD is falling. This is a bearish divergence. A bullish divergence occurs when the price of the underlying security makes a lower low, while the MACD makes a higher low.
Okay, so when a bearish divergence occurs, like on the chart, it means that the uptrend is losing momentum and it might reverse?
That's how traders interpret it. Yes, but this again must be viewed with caution. Sometimes momentum slows, only for the trend to continue, like in our chart. Before wrapping up this lesson, I want to quickly explain the limitations of MACD. A downside to the MACD indicator is that the moving averages are lagging the price and the price action.
Which means that price action isn't confirmed until after it happens, and we could miss a trade opportunity?
Yes, the MACD indicator is based on an average of historical prices and therefore it indicates delayed reversal points.
Thanks for the heads up.
Also, despite being an oscillator, it has no upper or lower bands, so it's difficult to really tell if a market is oversold or overbought.
MACD stands for Moving Average Convergence Divergence. It's a lagging indicator that's used to indicate momentum and trend. MACD is what's known as an oscillating indicator because it moves above and below zero. There are three parts to the MACD: the MACD line, the signal line, and the result of the signal line subtracted from the MACD line, plotted as a histogram.
If the MACD line is positive, the short moving average is above the longer one, and it's an indication of a bullish market. The same is true on the downside, which is confirmed by a negative MACD.
A signal line crossover can indicate a turning point in the MACD. A bullish crossover occurs when the MACD line crosses up over the signal. And a bearish crossover occurs when the MACD line crosses down over the signal line.
These crossovers are used by traders to suggest a trend reversal. However, when a crossover is extremely high or extremely low, the market should be treated with caution, as it could suggest a continuation of the trend rather than a reversal.
The MACD indicates divergence when its highs or lows aren't matched in the price movement of the underlying security. When this occurs, it suggests the trend is losing momentum and reversal is possible.
The MACD has its limitations. It's a lagging indicator, and we therefore might see delayed signals. It's also an unbounded oscillator, which means in theory it has no maximum or minimum values on which to base overbought or oversold analysis.
Thanks everyone for your input here. See you all in the next lesson.